Today we have a very special guest we here today. He's actually the executive director and the head of equity for Ping An of China Asset Management. So right now I would like to hand over the time to Mr. Vincent Che. Mr. Vincent, please.
Well, thank you, Darren. Good evening, everyone. It's my pleasure to give you a quick outlook for China equity and a quick introduction by myself. I'm currently the head of equity for Ping An of China Asset Management, basically in charge of the equity team. And I think for Ping An, I think the majority of you should know Ping An Group. So I'm not gonna spend too much time on here. So I think we're one of the largest insurer in the world, and we have total assets is about 11 trillion RMB, and then we have customers is over 232 million customers. So basically, our group is actually helping us do a lot of investments. And on this page, I think Darren already mentioned that Hong Kong China market was one of the worst market for the past 3 years. Especially many investors, I think, had a really great hope for China reopen last year, especially after the COVID lockdown. But the economic recovery did not come through, and China started to face a deflationary pressure. So at the same time, the property sector credit crunch continued, which led to a really weak domestic consumption demand. And also the credit demand continued to under pressure as well for the private sector. However, for the past 5 months, as Darren also mentioned, that we see a really good rebound. And then from the chart you can see, but recently we already see some correction. From bottom to the top this year, we see a 30% rebound for MSCI China. But we think this is mainly driven by 3 aspects. First is fund flow. Second is sentiment recovery, and also low valuation. So on the fund flow part, on the top left corner of this chart, which shows us that the flow is actually come from the national team. So national team has been net buying the CSI 300 ETFs since earlier this year. You can see the average daily trading volume of CSI 300 ETFs increased significantly compared to last year. And for Hong Kong market, the southbound flow, the first 6 months actually had surpassed the total amount of the last year. So which is the bottom left part chart. Right-hand chart we see for the foreign fund flow, actually the outflow was slowed. You can see that for the first 6 months of the outflow actually is gradually slowing compared to this first half of this year. So we borrowed some slides from some sell side. This actually want to show us actually the global positioning from the underweight position, and for the emerging markets. So the left hand chart actually show us emerging market fund actually the underweight for China actually start to decrease a bit earlier this year, and the right hand chart actually is a global. It's a global active fund chart. It's actually tracking around, I think, 1.4 trillion US dollar AUM. And you can see right now, overweight China is around 6%. And majority is actually the EM mandates and also Asia mandates. And right now, they're actually currently underweighting China. So aggregate right now, underweight China is about 3.4%, which a little bit compared to last year. At the end of last year, it's around 4%. So it's still underweighting, but actually underweight the amount, the magnitude of underweighting decreased a little bit. And this also shows that each 1% point change in positioning actually can bring in around 14 billion US dollar of flow. So this kind of flow actually it has a pretty significant impact for Hong Kong market. Probably not Asia, but for Hong Kong market, it could be pretty significant. And on the sentiment part, earlier this year, and some investors believe Beijing is finally heading into a right direction to rescue the property sector. So we have seen a series of policies to support property sector, such as the removal of the purchase curb, step up on the subsidies for the first-time home buyers, lower the down payment, and scrap the minimum mortgage rate as well. And also some local government start to buying some unsold homes to save the property market. So this is also showing that actually Beijing is pretty anxious about the property sector. So the sentiment in the beginning of this year actually start to improve. There's some other sentiment boosters in the early this year is the national team that to actually start of putting money into the Asia market. That's another booster, and also there's a newly issued a 9-point guidance, so which was mainly about the market reform and come out. It actually come out every decade, and this time emphasize on taking a multiple measure to promote a healthy development of the capital market. So all these all together actually helped in terms of the sentiment. So this chart is a survey for the fund managers. Is conducted by the BOA, Bank of America, Asia. And you can see the sentiment changes for the fund managers from May compared to April. Actually, we can see there's a lot of the before the wait and see kind of signs. It become moving into a building exposure or incremental sign of easing. If they see some sort of easing, they will most likely to increase their position. I mean, before it's more like a wait and see kind of stance. So we're pretty sure here. Just want to show you that actually the sentiment of the market actually did improve during April and May. However, having said that, the real economy, actually the fundamental of the economy actually is still showing a mixed improvement. So we can see the CPI is still under pressure. It did recover a little bit, but still pretty weak. And the PPI is still under deflationary pressure, and PMI is still hovering around the 50 line. And however, the export number is very strong, which provides some support for the GDP for the first quarter. But we believe there are some fund loading effect that's due to the upcoming the U.S. election, and the new export orders start to drop. You can see the bottom right chart. You can see that. So that's the new export orders start to correct a little bit. So and on the consumption side, we can see actually retail sales still weak. The recovery is not really significant, and the travel data actually did improve the most, but the spending actually still lag behind. And on the property side, the bottom left chart, which is it shows that the new home sales still really contracting at a quite alarming pace, and then it did not improve as I think the market expected. So the GDP actually first quarter 5.3, I think beat some market expectation, but second quarter 4.7, I think we see signs of weakness start to showing again. So I would want to emphasize that the real economy, the fundamental is not improving like what we expected. So here is our estimation of the HSI for the next 12 months. So we did assumption before the third the plenum meeting, and now probably we need to revisit our assumptions because the third plenum came out pretty neutral, but did not actually meet, at least did not meet my expectations. So it is very comprehensive paper and covered majority of the problems which China is facing right now, but it seems lack of main focus. So he talked about like improve the business environment, especially for the private sector, but he also emphasizing making the SOE bigger and stronger. So and then he actually did. It is good that it discussed the plans to better align the local government spending and resources. So we actually recognize the LGFE problems, and especially at the city and county levels. However, there's no sign of further property stimulus. So only echoing the previously mentioned policies. So this part actually missed some investor expectation. Also, I think missed our expectation as well. And the plan actually signaled the balance between the fairness and efficiency a lot. So, but in the economics, we all know that it actually conflicts. So if you want fairness or you want efficiency, it's actually these two things actually conflict each other. So that's why we see our base case right now is actually assuming this year, the for next 12, the EPS growth is 7%. And then we are assuming the forward multiple is around 9.5. But again, we probably need to revisit the multiples and to revisit our assumptions as well. So in general, for the current macro environment, we still see a lot of uncertainties for China. And there were a lot of policy supports mentioned by the government. And we do think Beijing actually realized the current problem and anxious about the economy, but we would like to see the policies can actually quickly transfer into the private sectors or into the corporate earnings. Because lesson learned from last year. So from last year actually we heard a lot of talking, but we did not see a lot of so much doing. So we hope that we will see a more speed up execution in terms of the policy mentioned in the plenum, and hopefully that we will see more supporting policy to have a better. So if we can see that, then we probably will see a better rally instead of I think the beginning of this year rally is not really sustainable. So under these circumstances, I think this one. So we actually recommend a barbell strategy, which is balance between the value and growth factors. So we can see from here. So on the left hand side is our value. So for the value part, we like the high dividend theme. So since we are currently under a really low yield and low return environment, so companies with a strong balance sheet and strong cash flow will prevail. However, if, just like I mentioned earlier, if the policy and execution of the policy start to pick up, and we believe the growth factor actually will start to outperform, especially the sectors that correct the most for a long time, such as the healthcare sector, the consumption sector, and so that's why we have this consumption recovery theme and also a China healthcare theme here. And on the technology part, I think it's a more long-term theme for us. Seems so we continue to like the local substitution theme, and also we believe at this time that the plenum actually they use a lot of wording on the technology innovation and also high quality development. So I think the tech sector is what we like for long run, and that will be my part. I probably stop here and pass it to Darren.
Thank you very much, Mr. Vincent, for the informative presentation. For me personally, I feel like a lot of us investors are always trying to stay ahead of the market. So one of the very important things I feel everyone should take away from that is the Hang Seng Index forecast for the next 12 months. The base bull and bear case have already been presented to you, as well as the barbell approach, including the four major factors: the high dividend, consumption recovery, China healthcare, as well as technological innovation. So I would like to thank Mr. Vincent once more for that informative presentation. And now I would like to move on to my part. Everyone, just give me a moment while I share the screen. Okay, so welcome everyone once more. So I know that, let's just take a quick breather. Okay, I would like to talk about just to absorb all the information that has been shared with us. So I'd just like to introduce everyone to our Poems Mobile Tree communities on our new and improved Poems Mobile Tree app. So if you'd like to be involved with other like-minded investors, you have a platform for information sharing, stay updated with our staff postings and more, then I highly recommend that you download the Poems Mobile Tree app and join our communities today. So additionally, by the way, you don't need to have a Poems account to view and post in our communities. Although, of course, I would highly recommend you having or opening an account. So some of our more prolific communities are US earning updates for our US traders early on. Not many of you here, but it's okay. There are growth stock picks as well, market updates, and even technical analysis, all available for free. So if you'd like to learn more, you can scan the QR code here and download our app to join the communities today. And just to give you a little bit of a glance into what it looks like. Okay, so for We have US earnings calendar, we have technical analysis, we even have an ETF. Um, it's like an ETF journal, so to speak, with like all the latest, newest ETFs, and then earnings calendar and easy to digest infographics. And for technical analysis, actually something a little bit special as well. We actually have a technical analyst. He's actually usually browsing the app, and if sometimes people ask him questions like, "Hey, can you do this analysis of Netflix for me?" And then this was actually a request someone made, like, uh, can you do analyze technical analysis for me for Netflix? And he actually came out with this within like an hour or two. I have a quick question here. So Poems Tree can download and use or need to have account to use it. So when you download the Poems Mobile Tree app, it actually prompt you to create an account, but it's not a Poems account. It's just like creating like a normal account for any other app. So you can download, go into the communities. They'll tell you, oh, set up your community profile, and then you can immediately go and see all this. Okay, so enough of that. Uh, back to the QR code. If you like, you just take a quick scan. Maybe later on, after the webinar is over, you can just go and take a quick look, create a profile, go to a community, see what's up over there. We have a lot of staff that are on there as well. Some of our staff actually pick up on requests, have a conversation, the like. Okay, so let's say you're more into Telegram. We're always finding ways to stay connected, and Telegram is one of the ways. Okay, so we also have many Telegram communities available. It's all for free as well. So this particular QR code will bring you to our Global Markets Telegram. That's one managed by myself and my team. So we have Asia market updates, US market updates, ETF news, all our events will be over there as well, and many other educational webinars we will post there as well. So if you would like to get more of our communities on Telegram, drop a comment on any of the posts there. We'll get to you. We'll recommend you the rest of the Telegram channel, even the technical analysis one, which is basically run by the same person on Poems Mobile Tree as well. You get the same advantage of the technical analysts on Telegram as well. Okay, enough advertising. Now let's dive right into it. Okay, so I have a very simple agenda for everyone today. So three agendas actually. So first, I would like to spotlight an ETF, which is 3070.HK, which I'll tell you more about in a short bit. This is actually a very interesting ETF. It's quite nuanced, and I'll explain a lot more about it later, so everyone has a good understanding before you invest. Of course, for your consideration. So after that, we have a very short comparison of stocks versus ETFs. And finally, we'll go through some Hong Kong value stocks that my team at Phillip Hong Kong has come up with, along with an exciting opportunity for you to take part in our lucky draw promotion that is live only until the end of this month, which is next Wednesday. And I don't want anyone to miss out on this opportunity. If you are a Poems client and you're thinking, should I trade Hong Kong markets now? Or maybe you're thinking, I want to trade Hong Kong markets now. Is there any deal for me? Yes, there is. There's a chance for you to win prizes in our lucky draw as well. Okay, let's move into it. So let's talk about 3070.HK, Ping An of China, CSI Hong Kong Dividend ETF. So just some basic information to get the ball rolling. The underlying index is the CSI Hong Kong Dividend Index. We'll talk more about this later on as well. It was listed in February 2012 and has an impressive AUM of more than $1 billion Hong Kong dollars. So currently the management fee of this ETF is a pretty modest 0.55% per annum. And if you take a look at the chart comparison here, you will see the blue and white line are very highly correlated, especially the year to date. And the accumulative performance, which you can see at the bottom, which we'll talk more about later, are actually, but if you look at it now and notice, they're actually all in the positives, which is a pretty rare occurrence. It's not a common occurrence to have everything in the positive, especially when we're talking about Hong Kong. As Mr. Vincent mentioned earlier, it faced a lot of issues for the past 3 years during COVID and the like. So here's a simple comparison. Okay, like when we want to base our investments and we want to base the performance, we always like to compare it with what has it been doing against other people. Okay, so let's compare. So here you can see the white line all the way at the top against some other key indices such as Hang Seng Index, CSI 300, MSCI China, S&P 500 Index, and the High Dividend Index, S&P High Dividend Index. So you, at a glance, very simply, you can see that the ETF has significantly performed other indices. And since the start of the Fed rate hikes, it has maintained a certain amount of resilience and even growth. Okay, the Fed rate hikes actually led to volatility across the global markets. However, this ETF has managed to withstand these pressures. It has a strong selection of underlying assets, which we'll touch on more later on as well. And for some investors seeking stability and growth. So this historical performance here is, of course, for your consideration. So this is why we put the comparison here, so you can see while other people were doing this, how has this ETF been performing as well? So this is in general the performance since the Fed rate has hikes during all the global volatility in all the other markets. Okay, so this ETF is modeled after an index, of course. So now we're just going to take a quick look at the index. So divided into 3 portions horizontally for you. I want you to pay attention first to the highlighted part in the first column. Okay, so here are some considerations for you, as earlier mentioned, looking for stability and growth. So this index consistently outperforms other major indices in terms of total returns over various periods. So if you see, we have the 3, 5, 10-year periods annualized and the year to date. You just take a glance across the board, you can see that it is significantly outperformed most of the other indices. Okay, so that's for the first part. Now we move on to the next. Okay, so it has also a relatively lower standard deviation compared to the other indices. And if this is actually, this is actually indicative that the risk is managed more effectively, and this offers a more stable investment option compared to some of its counterparts. Okay, higher and lastly, of course, higher risk-adjusted returns also suggest that for the risk that you are taking, you are compensated well. It balances your risk and your reward. So this is just a brief overview on earlier on we compared the charts, now we're comparing the numbers. So now we can see really in detail. Okay, so now firstly, you might not be very sure what this chart is saying. So this is actually talking about in the time where it was all the markets were like in the downside and everything. I want you to see what the performance of this index and ETF have been actually during this period. So we know that the Hong Kong markets have been in a downtrend for a while before this. So how did the index fare during this period is what we are looking at with these charts now. So what we're paying attention to is the dark blue bar that's all the way on the left. Okay, and in all the other colors, these are all the other indices that we were talking about earlier as well. But of course, the main character is the one in dark blue all the way on the left. Okay, so if you may have noticed in the earlier years, when there was a big performance lapse and all the markets were basically down, this index actually fared better as compared to some of the other indices. Okay, not saying that this index performed exceptionally well or very well. It's like, okay, going against expectations or anything, but okay, its downside was definitely cushioned and it was not as extreme as some of the others were. And observing the charts from the more recent years, okay, so now we move a little bit to the right, 2022, 2023, 2024 year to date. Okay, it actually started to pick up earlier than the others. And while they were still sitting in negative zones, this index actually started to move in a positive direction. And by the time the rest of them had like, oh, okay, we're coming out of this, we're moving in a similar direction as seen in the last chart, this CSI Hong Kong Dividend Index was very well into the positive zone with a 31% positive value. Okay, so from the period of 31st August 2010 to 28 June 2024, up until about a month ago, 28 June that is, it can be observed that the cumulative price return and the total return for the CSI Hong Kong Dividend Index is significantly higher than the rest, just at a glance. Okay, you don't need to go too much in detail, you just look at a glance, you can see the height difference. Okay, so this substantial difference actually serves to highlight the impact serves to highlight the impact, what was I saying earlier? Impact of reinvesting dividends on overall performance. And for investors, choosing an ETF that focuses on high dividend paying stocks like this can be a strategic move to enhance your long-term returns through dividend reinvestment. Additionally, dividends can also provide like a buffer against price declines. Okay, moving on. So a lot of charts here today, but I'll go through them in detail and then it will make sense. Okay, so this is a chart that depicts the correlation, okay, between the CSI Hong Kong Dividend Index and the S&P 500 Total Return Index. Okay, so from January 2009 up until December 2021. So you can see that's the longest line that you can see on this chart here. Okay, um, there was a mild positive correlation. So it suggests to us from seeing this 0.22, okay, that there was a modest relationship between movements in the Hong Kong high dividend stocks and that of the performance of US stocks. However, if you look, you can see that big drop going down, okay, into the shorter line that's nearer to the right. Okay, so however, after this January 2022, we can observe a significant shift between the two, of course, a shift downwards. So what does this mean for us actually? Well, we can use this ETF as a form of like tactical asset allocation. If seeking diversification is key, then investors can benefit from this reduced correlation. And how so? Okay, this is actually indicative that the ETF is less influenced by the volatility in the US markets because the correlation has gone from modestly related to almost barely, okay, not negative, but not going in the opposite direction, but not correlated to each other, okay? And you can benefit from this reduced correlation, okay? You can also act as a potential hedge against market fluctuations. Also, with the focus on high dividend yielding stocks in Hong Kong, it is also an option for investors who are aiming to enhance income generation and reduce their exposure to the US market dynamics. As you know, US is a whole show going on now with the elections going on and all the market dynamics are really all over the place. And sometimes you just want to, earlier on, I have some of the attendees, you all were saying, oh, I invest in Hong Kong. Maybe this is one of those things that you want to separate yourself away from for the US markets. Maybe this is something that you can consider. Okay. Now moving on, another chart. Okay. So we can discuss an attractive entry point that has presented itself due to the large discounts for H shares compared to A shares. So I'm going to assume that everyone knows H and A shares. Okay, so if you look at the chart on the left, the dark blue line that is higher, okay, the darker blue one, higher represents the Hang Seng Stock Connect China AH Premium Index, while the lighter blue that is low is the Hang Seng Index. We're all very familiar with these. As observed from this chart, the gap has continued to widen. As you can see, they came and then they touched and then they kind of separated and they're still going in like opposite directions from each other. Okay, the gap is continuing to widen so far from January 2021. And this widening indicates that H shares are trading at a significant discount compared to some of their A share counterparts. So if you look on the right side, we can see these are some that have A shares and H shares as well. Okay, so from this table, we can see the top 10 dual listed companies included in the dividend index. So these companies are dual listed and they are in the dividend index as well. So this highlights the discounts that are prevalent across the various prominent companies. Like you all know, Bank of China, ICBC, China Construction Bank, China Mobile. Okay. Interestingly enough, we'll go through some of these as our value stocks later on as well. Okay. So this highlights the discount. So of course down here it shows in Hong Kong dollars and in renminbi. But if you change that renminbi into Hong Kong dollars or you change that Hong Kong dollar into renminbi, you will be able to see the discrepancy in price. Okay, so also historically, you can even see a little bit of it on the chart on the left as well. Okay, big discrepancies between the H and the A shares tend to correct itself over time, which means investing in H shares now can give you a good yield as the market corrects and adjusts itself. Okay, from a fund flow perspective. Okay, so let's briefly explore on this. So in summary, for the chart on the left, I know there are a lot of charts today, but it's important. This data is important. Okay, so in summary, for the chart on the left, as represented by the dark blue line again, we can see that the percentage of shares being held by southbound investors is growing. Most notably, there's a steady increase in the shares held, which might indicate growing investor interest and confidence. So I just want to put it out there in case people are a little bit confused or are unsure about northbound and southbound. So southbound is actually what's coming out of China, so-called out of China, going to the south. So from China going to Hong Kong, and northbound is Hong Kong going to China. Okay, so this is the direction. Okay, just to clarify, in case some people are confused, oh, why you use North and South? Can't you just say out of China? So this is the terminology for it. Okay, so on the right, you can see is the southbound shareholdings of the ETF's constituents. Okay, the constituents of the ETF. And as you can see, it is moving in a consistent upwards trend with a spike in the recent one to almost 18%. Okay, so all this means something. Okay, this growth can also reflect increasing demand and positive sentiment towards the ETF's constituents. Okay, so southbound into the constituents is also increasing. Okay, that's what it means. So additionally, just 2 days ago, okay, onshore or southbound trading for this ETF 3070.HK had started due to the launch of the expansion of eligible ETFs under the Hong Kong Stock Connect. So you can expect southbound inflow for the rest of the year as well, because now it's open. Oh, southbound traders, southbound traders are able to trade in this ETF as well, not just in its constituents. So it's opening up to more investors, and we can see from the inflow that there is southbound interest that is developing and growing. Okay, and from the presentation earlier, you know that this is reliant on a few different things, including policies and all the other things that were mentioned earlier as well. So we are looking at an increase in the southbound or increase in the inflow from the southbound. Okay, so I just want to quickly wrap up this section with the top holdings. Okay, those who have attended my webinars or webinars that are hosted with webinars that I've hosted before, you will know that this is like my favorite slide. I always have this. Okay, it's just to break down and show you what's the constituents all about. It's a very simple thing. Okay, so I just want to quickly wrap up this whole ETF section 3070 with this. Okay, so some of which later, like Sino, Bank of China, we'll go through in more detail later. Okay, so you can see on the left the portfolio allocation by sector, and the financial sector of course dominates this sector with 44% allocation, followed by energy, okay, with about 30%, and communication services with 14%. And the rest of those little tiny pie chart parts, okay, comes from a mix of utilities, industrials, materials, real estate, cash products, things like that. Okay, actually, it's just those things. Okay, so that's it for this ETF. So now, you, for your consideration when you're going into, if you want to invest more, you want to diversify more into the Hong Kong market. This is for your consideration. So we're just going to move on and talk more about stocks against ETFs. Because we have mix from the audience earlier. Oh, I have stocks. Oh, I have ETFs, things like that. Okay, so very quickly. So owning a stock in a successful company, of course, can lead to significant gains, especially investing in the long term, and you have a greater control over your portfolio. You can choose companies you believe will perform well. You can choose, oh, I like this company, I like this company, this company's annual report is good, this company's earnings is good. And of course, with this upside, you'll be bearing a little bit of a higher risk. In the event that the company performs poorly, you know, a single bad company can hurt your portfolio. But for ETFs, on the other hand, it's like an instant diversification of portfolio. I have so many constituents. Okay, so now for your, okay, it's instant diversification with one single purchase, and it spreads your investment across multiple companies and reduces risk. So because they are diversified, ETFs are generally considered less risky than individual stocks. However, while offering lower risk, ETFs typically can have lower returns. So what's best for you, of course, depends on your investment goals, your risk tolerance, your risk appetite. Okay, some people are like, I'm going hard on this one. I have a bigger risk appetite. I want to go into single stocks. Some people are like, oh, I want to see how the market goes. I'm more invested into sectors, economies. I want ETFs. I want a lot of stocks at once. So it's up to you. Okay. So now let's move on to some value stocks that the team has come up with for your consideration. Okay, earlier on, this is also a constituent of 3070.HK actually. Okay, so firstly we have CNOOC, okay, CNOOC, okay, AA3.Hong Kong is the largest producer of offshore crude oil and natural gas in China, and one of the largest independent oil and gas exploration and production companies in the world. From the period of 1st January to 31st of March, the all-in cost was controlled and reduced by 2.2%. And here you can see in the graph, I know I am giving a lot of graphs. Okay, here you can see in the graph, you can see the performance comparison from last year. okay, where cost was reduced to 27.59 US dollars per BOE, which is barrel of oil equivalent. Okay, what this means last year to produce 1 barrel of oil is 28.22 US dollars, and recently it's 27.59 US dollars. Okay, so the lower the cost, of course, the better the margin. Okay, another chart. Another good point that we can see from here is that in Q1 of 2024, the company's net oil and gas production was 180.1 million barrels of oil equivalent, which is an increase of 9.9% year on year. Okay, CNOOC has onshore and offshore overseas production as well. You see the dark blue portion. I thought a lot about dark blue today. That's like the main point. Okay, the dark blue portion, you can see the growth in China is mainly attributed to increased production from new oil and gas fields, while the overseas growth was mainly due to production increase in Guyana and Canada as well. So it's not just in these two countries, they actually also have oil fields in Africa, North America, except Canada, and Europe as well. Okay, quick summary. Okay, CNOOC's ROA, ROE, net profit margin, and EPS, as you can all see here, the first row, okay, are all higher than the other two Chinese oil and gas companies as shown here. And what we're comparing to are PetroChina and Sinopec Corporation. Okay, so we'll just quickly touch on this, okay, because it's very self-explanatory. First, okay, what you're seeing here is the performance from last year. I actually took this from the annual report, and there are some of the indicators. These are like the indicators of growth. Okay, so as everyone can see, this has all increased, particularly net fee and commission income, okay, which has grown more than its peers in this industry. So if you look at the bottom left, you'll see PPOP. What is that? Okay, PPOP stands for pre-provision operating profit, okay, which is the amount of income that Bank of China made before accounting for funds. Yeah, made before accounting for funds set aside to battle bad debts, and is an estimate of their operating profit. Okay, that's it for Bank of China. Very straightforward. Let's talk about, oops. Yeah, okay, that's it for Bank of China. Okay, let's talk about China Shenhua Energy. Okay, 1088.HK. Okay, so their business is diversified. Okay, so from table 5 on the left, we can see that there's been a 3.5 increase in their total production from their 5 major mines in China and from 3 regions as well, which are Inner Mongolian. I am told this is pronounced Shanxi, and the next one is pronounced Shanxi. Okay, so in the first quarter of 2024, the company has also achieved a commercial coal production of 81.3 million tons, which is significant because it's actually a 1.5 increase, a 1.5% increase from the previous year. Additionally, in the first quarter of this year as well, a little bit more recent, coal sales were 117.3 million tons. It's not here, so just listen to me. I'll walk you through this. Okay, coal sales were 117.3 million tons, which is an 8.8% increase year on year. So out of this amount, self-produced coal was 80.3, which is a 1.1% increase from previous year, and purchased coal was 36.8 million tons, which is a 30.5 increase from the previous year. So besides selling coal that they produce, of course, their business model also includes selling coal that's been purchased from other suppliers, and after they process it, then they sell it. Okay, so from table 9 on the right side, we can see that they sell coal domestically over all the regions of China: northern, eastern, central China, southern China, northeast China. They might as well just put China. Okay, but we split it up a little bit. Okay, and so a large proportion of it goes into thermal coal. You can see towards the bottom, the second half. Okay, goes into thermal coal, followed by chemical production and metallurgy like steel refining. Okay, quick summary. So it is expected that supply and demand in China's coal market will be balanced in 2024, and coal prices will remain stable. So after the supply side reform, the operating conditions of the coal industry have been greatly improved, and coal companies have a strong cash flow and high dividend payout ability. Okay, the steel industry's inventories will be reduced after the implementation of fiscal policies, and demand for coking coal is expected to grow further. So in terms of domestic supply of coal is limited due to regulations, and the import volume of coal is expected to remain stable in 2024, and coal supply overall is expected to be tight, pretty tight. Okay, Lastly, the company has an advantage in terms of integrated coal, electricity, roads, ports and shipping, industrial chain. Okay, so it's one whole industrial chain. Okay, a high proportion of long-term coal sales contracts, so it's like agreed upon, stable performance, long-term focus on investor returns, coupled with high dividend ratio, and is driven by market value assessment of central enterprises. So its valuation is expected to increase even further. Okay, lastly, before I wrap up my session, a lot of charts today, but we learned a lot. Okay, so lastly, we have China Mobile 941.HK. So first, we can see an outstanding performance for CHBN markets. So CHBN means customer, home, business, and new markets. So in the year 2023, we see maintained growth across the board for all these aspects. Okay, you can see like plus 0.3%, plus 13.1, plus 14, yeah, okay. So you can see maintain growth across the board. Okay. Also, another across the board, customer scales have grown for China Mobile as well. So for 5G network customers, it grew by 138 million. Household broadband customer grew by 20 million. Okay, this is by the way, the chart doesn't mean they grew from 138 to 465. It means it grew by 138 million. So it's not like, whoa, that's so crazy. They grew like so much. Okay, it's still a lot. Okay, but a reasonable amount. Okay, so household broadband customer grew by 20 million, corporate customers grew by 5 million. So the total number of connections, you see all the way at the right, the total number of connections have also increased by a substantial 414 million to a grand total of 3.354 billion connections. This makes it the leading company in terms of total number of connections in the world. Okay, so some reasons for recommending this include having a high dividend with a stable dividend per share outlook. The company's cost control and efficiency improvement will also enhance its profitability. And so the dividend is expected to exceed market expectations. And the dividend yield is also 6.6% higher than other large cap telecommunications companies such as China Unicom and China Telecom. Okay, the company also insists on the integration and expansion of a term that they call connection plus application plus rights and interests, and improving the customer operation system. So in the home market, they have also increased their 5G users, 5G penetration rate, and home broadband customers as shown earlier. So, and also, by the way, they're delving into the development of 6G. So I just got my 5G phone like 6 months ago. Now they're talking about 6G. Okay, so we've come to the end of my part. Okay, so right now I would like to invite back Mr. Vincent for our Q&A session.
Hong Kong and China bank share can be good investment because the interest rate are coming down and the banks are asked to help out with the property downturns. Yes, I think the 2 points you mentioned is correct. So interest is coming down is actually impacting NIM, the bank's NIM, and also the asset quality. So basically, you're talking about if it starts to help out the property sector, it will actually hurt banks as asset quality. But I think a lot of this negative or sentiments are already actually in the price, or actually it was there already. So you can see actually the bank names actually rally from the bottom from last year until now, probably the sector around like 20 to 30% already is because, like I mentioned earlier, because of the uncertainty of the macro environment, investors would like to hold the strong cash flow names. And on the other hand, also mentioned earlier, the national team is actually bottom fishing a lot of this strong cash flow names. So yes, NIM and asset quality will actually the impact, and that's not new. That's already ever since the Chinese government started to crack down on the property sector, that worry already happened. So, but right now, looking forward, we're seeing the actual national team is coming in. Strong cash flow will actually benefit for for a lot of investors if they're looking for yield. I think right now, still for the banking sector, average probably around 5%, and especially even though right after the 20-30% rally of the stock price, it's still giving you a 5% yield. That's a pretty good deal, I think. And also, that's the valuation after the rally is still not too stretched in terms of PE and PB. So that's why I think banking sector is still okay. Okay, there's a when Hong Kong market expect to when Hong Kong market expected to recover after the U.S. election or rate cut. I think the recovery is mainly actually should be driving by the fundamental of the economy of China. So like I mentioned earlier, that we would like to see a lot of this policy from top down actually start to kicking into the corporate earnings, especially we'll see the real economy start to recover, then the Hong Kong market will start to have a sustainable recovery, not the sentiment-driven short-term kind of recovery. And the U.S. election, we believe it will be it's part. It's right now. I think the Donald Trump is pretty. I think there's no doubt at this moment. But I think how the Senate turned out to be is whether Democrat or Republican. I think that's a lot of people still waiting and see, and also what will be the impact on the tariffs. I think that is also another risk for the geopolitics tension and so on and so forth. Yeah, I think the U.S. election will be a risk that need to monitor. But if the China economy start to actually recover better than expected, I think that will be the main driver for the Hong Kong market.